This is a podcast from the Business Times.
Good evening. It's Monday, July 27th, 2026. Here's your market focus daily closing bell update by the Business Times. Asian shares rose as a temporary pause in the fighting in the Gulf pushed oil prices lower, lifting investor sentiment and easing inflation fears ahead of a crucial week for central banks and earnings. MSCI's broadest index of Asia-Pacific shares outside Japan rose 0.5%. South Korea's chip-heavy Kospi index firmed 0.97%, while Japan's Nikkei edged up 0.5%. China's blue chip index, the CSI 300, gained 1.15%. Oil prices extended losses as signs of a temporary easing in U.S.-Iran hostilities overshadowed ongoing risks in the two critical shipping routes. Iran reportedly said it would suspend attacks as long as Washington maintains its military pause, after the United States halted its bombing campaign following concerns over limited military targets and the declining weapons inventories. Brent crude futures for September delivery fell more than 4% to around $92.85 a barrel, while U.S. West Texas Intermediate crude dropped 4.46% to $84.33. However, geopolitical tensions remained elevated after Yemen's Iran-backed Houthis-targeted Saudi oil sites along the Red Sea coast, while Tehran accused Ukraine of attacking an Iranian ship in the Caspian Sea. Even so, the sharp decline in crude prices offered investors relief from inflation concerns and led markets to modestly dial back expectations for further Federal Reserve rate hikes. Chinese chipmaker Changxin Technology Group, or CXMT, made a blockbuster market debut, with shares surging 500% on Shanghai's STAR Market. The company raised 57.92 billion yuan, or US $8.6 billion, in Asia's biggest IPO this year, lifting its market capitalization to roughly 3.3 trillion yuan and catapulting it to become China's most valuable listed company. Meanwhile, on Wall Street, earnings season reaches a pivotal stage this week as several major U.S. technology companies are prepared to report. With earnings growth expected to remain strong, investors are increasingly focused on whether the billions being invested in AI infrastructure can deliver sustainable returns. Against a backdrop of elevated valuations, companies may need to do more than exceed earnings forecasts to justify current share prices. Alphabet offered a reminder of that last week, with its stock falling nearly 7% after reporting negative free cash flow. The AI spending race continues to escalate, with reports that NVIDIA is in talks to provide a roughly US $250 billion funding backstop for OpenAI's data center project. Some key earnings this week include Microsoft, Meta, Amazon, Apple, and Qualcomm, together with major industrial, defense, and healthcare companies. Shifting our attention to the upcoming U.S. central bank decision, while the market consensus expects new Federal Reserve Chair Kevin Warsh to leave policy unchanged, investors will be watching closely for any dissenting votes that could signal a more hawkish outlook. Elsewhere in the world, both the Bank of England and the Bank of Japan are expected to keep policy settings unchanged at meetings later this week, though policymakers are likely to reiterate concerns over persistent inflation. The delicate balancing act facing central banks was underscored by Singapore's surprise policy tightening today, as the Monetary Authority of Singapore, or MAS, with a slight increase in the rate of appreciation of the policy band. Unlike other major central banks which rely on interest rates, the MAS guides monetary policy through the exchange rate. Finally, U.S. futures are pointing to a firmer start, with all three major indexes edging higher as investors await a packed week that could set the tone for markets. That's it for today. For more business news and market updates, visit bt.sg and Lens on Daily for the latest tomorrow at 10 a.m.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.